Welcome to Peachtree Point of View with Greg Friedman, the podcast that shares insights and strategies to navigate dislocated markets and capitalize on mispriced risk.
This is Greg Friedman with Peachtree Group, and today we're doing another market update quarterly call. And I'm joined today with Mark Zandi from Moody's, who's participated on many of these calls in the past with us at Peachtree, as well as Daniel Savage, who's with our investor relations team. Mark, you cover obviously a lot of what's been happening economically. There's been a lot of volatility in the marketplace, given everything happening geopolitically. If you could give your state of the union on the marketplace and what you're seeing happen, we'd love to get your thoughts.
Thank you, Greg. It's good to be with you. So the economy's growing, but it's a tenuous growth. You can see the growth in GDP. That's the value of all the things that we produce. That grew 2% last year, pretty much on the nose. And in the first half of this year, got a data point last week, it showed that the economy grew just about 2% in the first half, slightly less than 2%, but pretty close. And that's what I expect, more or less. There'll be some volatility up and down quarter to quarter, but cutting through the noise, I expect 2% growth for the second half of the year, 2% growth for 2027. So just a boring forecast. A lot going on underneath the hood. We'll get to it in just a second, but from the top line, very stable growth. It's tenuous because 2%, it's okay, but it's not quite the economy's potential rate of growth. And you can see that in the job market. The job market remains soft, but the underlying rate of job growth, abstracting from the noise on a monthly basis, is probably 50 to 75K, something like that, which is pretty soft. And most of the growth, the bulk of the growth, is in just one sector of the economy, the healthcare sector. The rest of the economy, some industries are adding a little bit, some subtracting. The net is basically a wash. And at that rate of job growth, it's not quite enough to absorb, the kind of the underlying growth in the labor force. And slack is developing, and we're operating a little bit below full employment. Even with a 4.2% unemployment rate, the participation rates have come way down. And you can see that in the steady deceleration in wage growth. That continues to be the case, and that's consistent with an economy that's operating just below full employment. So, it's okay, but it does leave the economy in a kind of a tenuous, I keep searching for the right word, fragile place. Nothing else can kind of go off script. To get to the 2% growth, a lot going on, obviously, a lot of headwinds, a lot of tailwinds. The headwinds are most obviously the Iran war, and my working assumption here is that the president will figure out a way to wind this thing down here in the next few days, few weeks, in a reasonably sustainable way. The strait will open up, oil will start to flow, and these oil prices we're seeing now in the marketplace, $75, $80 on a barrel oil Brent. That's kind of sort of where we land here through the end of the year. A bit lower next year. We're not going back to pre-war for a while, given the risk premium that'll be built in. The kind of the equilibrium pre-war was about $60, $65 a barrel. So a bit elevated, but that's kind of my assumption. And that assumption is based on the view that it's in everyone's best interest to bring this thing to a halt. And from the president's perspective, if this goes on for much more than another few weeks, month or so, global oil inventories will get to such a level that we'll start to see price spikes and actual physical shortages in different parts of the world. So that's my working assumption. I say all that with very little confidence. Obviously, things can go off rails, and that's the biggest risk or threat to my 2% kind of growth trajectory. But that's really key that scenario I just described kind of plays out. But the other headwind to growth has been playing out the last year. This year is deglobalization, the tariffs, trade war, export restrictions, investment controls, restrictive immigration policy that's becoming more of a binding constraint in many industries as immigrant workers leave the country and leave the labor force. Labor force is contracting, and that makes things pretty tough. And it adds to inflationary pressures. I mean, I think businesses in immigrant-dependent activities they're not raising wages because they know higher wages won't attract any other additional workers. So they are raising prices to get the demand destruction they need to equate demand with their reduced supply. And so that's adding to inflationary pressures. One reason why so-called supercore service inflation, that's service inflation, ex-energy services and housing, remains persistent, and that's particularly important in the context of Fed policy. Fortunately, there's the AI tailwind, and boy, is that blowing hard, primarily through CapEx. It's not, the CapEx contribution is significant. One caveat: a lot of the CapEx is imported, so that takes away from growth here. I mean, Taiwan, believe it or not, it's growing 10%. GDP is growing 10%, and that's just craziness. And that's all the chips coming from Taiwan here to go into those data centers. The other channel through which AI is lifting growth is, of course, the surging stock market and AI stock prices, and that's really key to the net worth of high income, high net worth, well-to-do, and their spending, and that spending is allowing the economy to move forward. That consumer spending growth in aggregate is not shockingly 2%, consistent with consumption being a big part of GDP. But all that growth is folks in the top 10, 20, maybe 30% of the income distribution. The rest of the population, income growth, spending growth is after inflation, after tax is flat at best, down a little bit. So a big bifurcation among consumers, but on net, in aggregate, it's enough to keep the economy moving forward. I don't see that changing anytime soon. I mean, in the baseline, I have the CapEx continuing on. I do think the markets are overvalued. I'll come back to that in just a second in the context of the risk. So I do have the equity market kind of going more sideways here for a while, letting everything else catch up to it, get price earnings multiples back to something that are more consistent with what we've experienced historically. But even with that, there's a lot of wealth created. I mean, I think the value of all publicly traded stock has more than doubled since ChatGPT was put on the planet, and that's like almost $40 trillion. That's a lot of wealth. That's powering a lot of spending, and that wealth effect, so-called wealth effect, will continue to play out here. I also think that inflation will moderate despite the stickiness in the core service inflation. I do think, if I'm right about oil prices, that'll help significantly. And I think the most encouraging thing remains that inflation expectations, at least as measured in the bond market, are stable and consistent with the 2% inflation target. And I think that should provide a lot of solace that that'll be a strong gravitational pull on inflation, and we'll get back down to target. Not the end of this year, maybe not even this time next year, but towards the end of 2027, everything sticks to script, early 28, we should get inflation back within spitting distance of target. So a relatively sanguine outlook. Now, the Fed, a lot depends on the Fed. I'm right, I think it's a close call, but I expect the Fed to kind of hold the line on interest rate increases. I expect them to kind of navigate through at the current federal funds rate target of 3.5 to 3.75 this year, next year. But I wouldn't argue with anyone if you said there's a 1 or 2 or even 3 quarter point rate cuts coming, rate increases coming. I think that's not an unreasonable expectation, given all the uncertainty here and the persistence of core service inflation. I think that might be too much for policymakers to bear. So I think there's a high probability. So I wouldn't die on the hill of arguing that one, but our baseline is for no rate increases this year and next. And the other thing I point out is long-term rates are up a lot, and they will do some damage to growth, and perhaps do some of the Fed's work. If the Fed doesn't raise rates, long-term rates, we're at 6. Last I looked, we're at 4.65 on the 10-year Treasury. And that'll start doing some real damage, particularly to the housing, single-family housing, because for fixed mortgage rates will be closer to 7, and that would be too much for most potential buyers. And it may even create some more additional problems for CRE mortgages as they roll over at a higher rate. So it'll do some damage and may do the heavy lifting for the Fed, and they might not raise rates. Now let me end by just calling out a few threats to the optimism, and I do think the risks to my kind of baseline view, which I think you could characterize as pretty sanguine, are to the downside. There's some upside risks, but I think mostly to the downside. And the Iran war, obviously, the equity market and valuations more broadly in the financial system. I mean, take a look at the bond market. Corporate bond spreads are paper thin. I mean, they're a couple standard deviations away from any kind of historical norm. And, there may be some idiosyncratic factors that are contributing to this thin spread, but they're pretty thin. So, valuations are high. So we could see significant correction in the stock and bond markets. And, that would be a problem in the context of those wealth effects I was describing earlier. I do worry more about Federal Reserve policy mistake. I mean, I do think the new Fed chair's position on reducing the transparency of how the Fed operates is going to create more volatility and just make things more difficult. It's one reason why long-term rates are up. The term premium in the long-term bond yield is up because of the uncertainty created by this shift in kind of communication strategy that's likely ahead of us. I think there's a greater possibility Fed just gets it wrong. Might raise rates too aggressively too soon, or might cut rates too quickly too soon. It's just a mistake, one way or the other, because of the volatility and the shift in policy. And then finally, I just throw out one other thing that is on my mind that probably is not getting as much attention, but probably should, is AI and cyber risk. I do worry about the possibility of more cyber problems, particularly in the banking system. Not among the big banks, because they have plenty of resource and they know what they're doing and are, I'm sure, on top of things. But I worry about smaller banking institutions, credit unions, and if you see a string of cyber incidents that that might spook depositors in those banks, and we could see a run to the money markets or to stablecoin or to the big banks themselves to be safer, and kind of sort of like a variation on the banking crisis we experienced for a month or two back in 2023, when the banking system kind of choked on the higher rates at the time. So, and if it's not the cyber, it could be some other AI incident, because it's almost as if we need some kind of incident to generate the political will necessary to make kind of the regulatory legal changes that are important to make, and this has to be done globally to make sure that AI is more friend than foe. So I worry about that as a risk. It's not my baseline, but I think it's something to call out, and to hopefully the powers that be start to think about this more clearly and execute on drawing some bright yellow lines around the use of AI. With that, I'll stop. I covered a lot of ground I didn't cover, but happy to entertain any questions that you have. I'll turn it back to you all.
Yeah, that was very helpful, Mark. That was definitely a lot of ground. Like, what, just from a standpoint like the 10-year, just because obviously the 10 years has surged over the last several months, where it's above 4.5. I think it's around 460, 465 today. But it's obviously that has a closer correlation to the values of commercial real estate. The 10 years elevated. From your viewpoint, inflation's moderating, and there's probably not going to be a rate increase. There's more likely rate cuts over the next 12 months. I mean, do you see the 10-year coming down at all, or do you think it stays above 4.5%?
Well, obviously it goes up and down all around, day to day, week to week, even month to month. But if you cut through that kind of noise, I don't see long-term rates coming down to a significant degree. I think it feels like what I call the equilibrium yield, again, cutting through the noise, had been between 4 and 4.5, and now it feels like it's more like 4.25 to 4.75, maybe even 4.5 to 5. And the reason, there's several reasons for that. From a mechanical perspective, it's really all about the term premium. That's where all the increases occurred. I mean, if you look at inflation expectations that I mentioned earlier, they're anchored at 2.25 on the 5-year or 10-year break evens. And real short-term rates have risen, but when you add the rise in real short-term rates and the decline in inflation expectations since the war began, you get kind of no real change. So all the actions in the term premium, and that's the melange of stuff. And I mentioned the shift in the communication strategy at the Fed. I think that's adding to it. I think the uncertainty around the Iran war and all the other things that drive inflation, that's adding to it. There's more inflation uncertainty. That's adding to it. I also think you can make a case that the kind of the equilibrium yield, the R star, the natural rate of the interest federal funds rate is higher because of the kind of what's going on in financial markets. I mean, the way monetary policy gets transmitted through the economy is through financial conditions, and financial conditions are incredibly easy. The equity markets skyward, credit spreads are paper thin, as I mentioned. Bank credit it's pretty good and getting more ample given changes in capital and liquidity requirements. So it feels like to get the economy to where you want it to be, you might need a higher interest rate. So the equilibrium yield is not 3%, which is where the Fed has had it, at least in their thinking, for quite some time. It may not even be 3.5% where it is right now, but it may be something closer to 4%. And then you've got the argument that with AI, we at some point here we're going to see higher productivity gains and higher kind of underlying potential growth, and that would also argue for a higher equilibrium yield. And then of course, the one thing that's on everyone's mind is all the debt issuance. I mean, the fiscal situation is pretty ugly. The deficit this year is going to be 6% of GDP. The primary deficit ex interest payments is going to be 3%, and we're at full employment. So that's kind of scary stuff. I mean, the primary deficit should be zero. It should be positive, when you're at full employment or close to. And the trajectory here looks bad. If you just take a look at current policy, nothing else changes. Even assuming a lot of tariff revenue down for the next 10 years, the deficits are going to remain very large and the debt load is going to continue to rise. And then you throw in all the corporate debt issuance that's occurring, related to the AI build out. And by the way, the fiscal situation here is bad, but it's bad almost everywhere else on the planet. We're certainly moving in the wrong direction. So, you add all that up, it feels like, rates are going to remain more elevated than the kind of, again, I'll end where I started, that, the range isn't 4 to 4.5, it's 4.25 to 4.75, maybe even migrating up to 4.5 to 5%, something like that. That's kind of sort of how I think about it.
Yeah, Mark, I'd love to ask a question and stay on the long-term rates conversation for a moment. I think over the last few years, we've heard commentary about the potential for lowering rates, then having a relationship between cap rates and them also coming down and creating value that had previously been lost in the interest rate hike cycle. You make a comment that longer-term rates are up a lot. The spread right now between appraisal cap rates and the 10-year is something like 25 or 26 basis points. It's historically over 200 basis points. Do you think there will be upward pressure on cap rates and further value dilution? Or effectively, do you think there's going to be a new normal and the risk premium is just generally going to be tighter?
Well, I'm an economist and I believe in mean reversion.
Yeah, indeed.
It's kind of worked out. Yeah, it kind of worked out that way historically. When you actually revert could be, take some time, and there's lots of different ways of mean reversion, achieving that mean reversion. But the cap rate spreads are very consistent with what I said about the corporate bond spreads and the equity valuations. I mean, asset prices are juiced, and that would argue, in all likelihood, that we'll see some mean reversion. We might not go back to the mean that prevailed prior to this run up in valuations, but it does feel like that we're going to move in that direction. So I guess I would answer by saying I think a prudent planner wouldn't count on those thin spreads, those kind of holding their own through the investment horizon. I think more likely will be higher than that.
Sure. So would you anticipate or even prognosticate that the real estate recovery will be further elongated?
Yeah, I think this run up in rates and everything that's happened I felt more optimistic a year ago about that. I mean, I did think, inflation, if we didn't have the tariffs, if we didn't have the immigration policy, if we didn't have the war, inflation would be back down to target. We'd be at target right now. You can easily do the arithmetic. It's pretty straightforward. And, I thought that was going to be the direction we were headed. And, the 10-year yield would not be headed north. It would be kind of 4 and 4.25, maybe even headed a little south, into the 3s, something along those lines. Valuations have really gotten a lot more juiced over the past year as well. Speculation's creeping into different parts of the markets. So that's momentum players. So leverage, the environment has moved in the wrong direction. So I'm less optimistic about that. So I think, yes, I think the recovery is going to be more elongated. It will be important to see, what was more debt rolls over at these higher rates, how much of that can be managed, well and gracefully. We've been down this road before when rates popped earlier, a couple, 3 years ago, and there was a lot of efforts to kind of extend and the old adage, extend and pretend, that's too pejorative, but, just to kind of manage through the higher rates because underlying demand for space was okay, or demand for whatever the corporate businesses are selling was okay. So, the economy's okay. So we'll kind of manage through and hope rates come back in, look like they were, but now it does not look that way. And so that it'll be, again, important to see how creditors respond and, exactly what they do. Also regulators, exactly how will they respond, to all this, and will they show the same kind of forbearance?
Yeah, and actually, I'd love to bring you into this question too, Greg. I'm going one more ripple out on the pond. So effectively, if we have an elongated recovery period, you've got real estate owner operators and borrowers who are going to probably get into more debt maturity scenarios, and it's going to be a little bit more precarious. What does it look like, and how does this impact debt capital markets and the lending environment for banks?
I think just given the current market conditions, I think this sort of sets up where there's going to be a lot of loan maturities where borrowers are going to need to, commercial real estate borrowers are going to need additional capital in order to effectuate a refinance or recapitalization. So, there's going to be a need for a lot of pref equity or additional equity to be injected, or even that's sort of where private credits played a role in commercial real estate over the last couple of years, is sort of backstopping as these loan maturities were occurring. Because to your point, Mark, there's been a lot of extend and pretend. So the wall of debt maturities has continued to grow, but there's a lot of fatigue within the debt market. So I personally see it as it is definitely a challenge, just given the amount of debt that's maturing over the next 18 to 24 months, which I think is around $1.5 trillion of commercial real estate loans maturing. But it's also a huge opportunity, I think, on the investment side for certain groups, because I think there's going to be some major headwinds around it. I think one thing it would be interesting, just using that question, for you, Mark, just in regards to the K-shaped economy. That's one thing we haven't talked about today, really, is just the impact on the lower side. Like, it seems like, and you're seeing that impact obviously across the board. Do you see anything changing the K-shaped economy, or do you think it's only going to get worse for the for the lower part of that K?
Yeah, they're obviously under a lot of pressure, but they kind of hung tough. And I think that's because they have a job, right? The unemployment rate is still low. You don't want to lose your job because hiring rates are also very low, and it's very difficult to get back into the labor market. But, so far so good, the unemployment rate. And a lot of people are dropping out of the workforce because they can't get hired or they're discouraged. So that's kept unemployment down. But generally, the job market has held together reasonably well. And people are working. And for lower income households, folks that stay in the bottom third of the distribution, that's absolutely vital and critical. Otherwise, they've got some pretty tough choices financially to help them make, because they have no savings and they've already levered as much as they probably can. And given the higher rates, the interest costs are going to start rising here for them on their credit cards and other liabilities. For middle income households, job also is most important. They do have some wealth. They probably have a 401k, so they're benefiting a bit from that. They own a home, although housing values have kind of gone basically sideways here over the last few years. But for them, also a job. So as long as the job market, hangs in there, and we don't see layoffs pick up, AI really isn't overly disruptive, with the economy can adjust to it in a reasonably graceful way. I think the K-shape will remain firmly in place, but the bottom part of the K won't fall apart. Now, if this goes to the risks. If high income, high net worth households, they'll keep spending. They don't for a while. They don't necessarily need a job. At least for a while, they've got savings and they've got wealth, and they can kind of manage through for a bit. But if if the stock market were to stumble, correct, go sideways, fall to any significant degree for any length of time, and then they pull back on their spending or just become more cautious in their spending, then we might start to see layoffs, and then we got a problem for the bottom part of the K. Then that's the fodder for an economic downturn, for a recession. But broadly speaking, the bottom of the K is under pressure, but managing through, should continue to manage through if the labor market hangs together. I think that remains to be the most likely scenario, but obviously a lot of risk around that.
Do you have any concerns around? I know we've talked about private credit, and obviously we do a lot of direct lending across all commercial real estate, hotels, multifamily, industrial, retail. And we actually have bought a lot of debt over the last 12 months from banks. We bought about $1 billion of loans from banks, primarily at discounts, where they're just looking at deleverage exposure. Loans are maturing and so forth. So, we have our own view internally just on private credit, but there's no question private credit has grown dramatically coming out of the GFC, but it's grown, probably more dramatic over the last 3-4 years. And there's been a lot of noise with private credit, especially on the corporate private credit side, and as well in regards to the structure. A lot of groups use these evergreen structures where they give liquidity, or you can get quarterly redemption. So it's an illusion of liquidity because the underlying assets are illiquid. So there's been some challenges there as well with the redemptions and so forth. But what's your take on private credit? Or do you have a concern, or Moody's have a concern with private credit, specifically in real estate right now, or what do y'all see from that perspective?
Yeah, I'm less concerned than I was a year ago. A year ago, it felt like private credit growth was rip roaring. Very rapid growth. There was a move towards, at least from my perch, retail, bring more retail investors in. And that's always a sign that things are getting overdone. And obviously that all that conflates with the kind of the more fundamental concerns around transparency and mark to market versus mark to model kind of valuations, lack of regulatory oversight or even insight into what's going on in the private credit world. But over the past year, there has been a bit of a comeuppance. Obviously, the BDCs have really got hit hard when concerns about AI took out the stock valuations of SaaS companies, many of whom private credit had invested in, and it certainly affected the valuations of their portfolios. And so they came under the redemptions and a lot of pressure. That really has slowed growth, and I think kind of chastened investors. It kind of spooked potential retail investors and slowed things down, cooled things off. And at the end of the day, the BDCs have kind of navigated through. They came under a lot of, maybe the script is still being written. We'll have to see here, but at least so far they've done a pretty good job of kind of navigating through the redemptions and kind of managing what's going on. So. And I think, the events of the past year have also shown a bright, shiny light on the industry, and I view that as a good thing. We want more people looking at the industry more carefully, just to make sure that everything is, moving in the right direction and not in an untoward direction. The banks seem to be, kind of coming back into the game. I mentioned the regulatory and legal environment shifting a bit. I think it's the economics around capital have changed a bit, so it feels like the banks might be re-engaging, and I view that as a positive development. Unless there's the aggression laws kicks in and there's kind of a drive to the bottom in terms of underwriting, but I don't sense that. What I sense is the banks are providing a bit more discipline to that type of lending. So I think I'd say we should clearly monitor this. Hopefully we get more transparency, more information, so we can evaluate and assess. And I think that's happening. That'll happen. So I feel better about the private credit market today than I did a year ago. And at the end of the day, it's still pretty small in the grand scheme of things. It depends on how you calculate. But last I looked, we're kind of around $2 trillion outstanding, and that's kind of the junk corporate market. That's kind of the leveraged loan market. There's 15 trillion in non-financial corporate debt outstanding. So, it's not inconsequential why it was it's been on the radar screen and should remain, but it's not large enough, I think, at this point to be existential to the financial system. One final thing I will say, I did write a paper with a couple of internal and external authors on private credit and systemic risk. It's not an easy read, but you might find it of some value. We do find that private credit is more systemic than it has been historically. No surprise compared to back in the GFC, the global financial crisis. Is called private credit and systemic risk. And you Google that, Zandi, you'll go right to it.
Yeah, I'll definitely check that out. My final question is really just in regards to if you're allocating capital today personally, and you were going to invest in real estate, would you rather be investing as a lender where you're investing at 65, call it 60 to 70% of current value, or would you rather be investing on the equity side, hoping for value appreciation, just knowing everything from an economic backdrop right now on what you expect over the next 3 to 5 years?
Well, I guess it depends on your horizon, but if it's kind of a short-term 1 to 2, 3 year kind of horizon, I think I'd be in the debt business as opposed to the equity business. That'd be my sense of it. But if my horizon was longer, if I had a 5 to 10 year horizon, I might take a different perspective on things. But near term, I'd probably you said 60, 65% LTV. That sounds like it's kind of a place I'd like to be. And I don't know where you are, Greg. So hopefully it's not inconsistent with your perspective on things. But that's what makes a market.
That's been the majority of our capital. We've been allocating more towards credit, where we're doing the 60 to 70% lending on acquisition costs, development costs, or just refinances at 60 to 70% of current value. And I mean, we feel like that's
there
better.
You go. We're right in sync then.
Yeah, we're exactly in sync there. So, I mean, it's hard to, I think the equity side's more about rifle shooting into opportunities or coming in where you're providing some type of rescue capital. That's where we're seeing more compelling opportunities. And selectively, you're seeing some opportunities on the development side because there's no new supply getting built. So there are some, certain markets that are still underserved where you can develop and you feel really good about your basis and about, what's happening in those markets, but that is definitely an anomaly. It's not something you're not going out and building, 1,000 new, multifamily properties or hotels a day. It's more selective than ever on that side of the equation. But Daniel, I guess any other questions before we close it out?
Yeah, Greg and Mark, just one last question, and it's very aligned with Greg's previous question. Mark, are there any market catalysts that you could perceive in the next 3 to 5 years to do exactly what you just indicated, is maybe move the opportunity set from credit back to equity? And what would that really take? Is it the great capitulation of 2029, or is it more of a gradual value reset and taking advantage of that? Would just love to hear what catalysts you think are going to be out there.
Yeah, I think it's just kind of getting through this now period of higher rates and seeing how owners and creditors kind of manage through. I suspect there will be some additional price weakness here for the next year or two. But then again, it goes back to your horizon. If you extend out your view a little bit longer, within the next 1, 2, 3 years, I think you'll start to see, you have to have some fortitude, obviously, because prices are soft. But that's when you would start to get back in and, prepare for the higher prices that will ultimately come. I mean, I think I'm ultimately very optimistic about the American economy and therefore optimistic about equity, bonds, real estate, longer run. I think we have just as long as we don't screw it up, we got a juggernaut of economy. We do a lot of things right. And, I would be long run more an equity holder than a debt holder. How about that for a happy ending?
Yeah, that's great. Well, we really appreciate your insights. And as always, we really appreciate the update on what you're seeing happen across the marketplace. So thank you for participating today, and thank you for everybody that tuned in. Again, Mark, thank you, and we'll talk again soon.
Yeah, thanks. I really appreciate it. Thanks, everyone. Take care now.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.